Hi guys, welcome back. Today we are going to finish our discussion on the valuation across the company's life cycle. From young companies to growth companies to mature companies, we are now going to focus our attention on companies who are already at their declining stage. So, how are we going to define what a declining company is? We will begin with the definition. From the previous video, we have learned that mature companies get most of their value from investments that are already existing or invested in. So again, mature companies get their value mostly from those investments that were already existing at that point. What then is a declining company? Declining companies get all of their value from investments already existing or invested in. So, what about the investments that are yet to be made? Recall we have what we call growth assets, those assets that are yet to be invested in. How are they being treated in a declining company valuation? Well, these are generally so small, maybe zero in value or even in negative value. Considering that the companies are already at their declining phase, growth is already negative. So it is not unlikely to see that we would find that value is being destroyed at the terminal value, for example, with a negative growth rate. So this is basically what a declining company is. So to be specific, let us enumerate some characteristics. Characteristics of declining company includes: first, there would be a flat or declining revenues. Revenues are no longer growing. So I want you to imagine a company that went bankrupt in the past decade. Say for example, Kodak. Kodak has been exclusively focused on the production of film-based cameras rather than shifting to digital. Now, as a result, the sales of Kodak's cameras and other items went flat or was decreasing in its late stage for some period before eventually Kodak declared bankruptcy. So when a company is in decline, the revenues are declining as well, or if not declining, at flat, or maybe increasing just to match the inflation in the economy. As a result of declining revenues, we would also expect that margins are shrinking. Although both revenues and variable costs are going down, there would still be fixed costs that needs to be recovered. So if revenues are declining, the margins are definitely going to shrink as a result of having a lot of fixed costs not recovered. Margins are shrinking if not negative. Then we would expect this company to have a lot of asset divestitures. Rather than having a lot of new investments, the opposite is true. Declining companies are selling their properties, their equipment, their machinery, or whatever the business requires as a result of not being able to grow its operations anymore. Next, we have significant payouts of cash. So if the company is already in decline, we would expect that it should be giving cash back to its investors. So shareholders are expected to receive a liquidating dividend or maybe a stock repurchase just to put out cash, this excess cash that have no more use for the company, considering that there is now a limit on the projects that it can make profitably. So again, we would expect significant dividends and stock repurchases to distribute excess cash. Then finally, for those companies who were using a lot of debt, the use of debt may cause financial distress. This happens when the declining company fails to, say, make a principal or interest payment to one of its lenders. The use of a lot of debt early before the decline may cause the company to enter into a financial distress, which may lead to bankruptcy or even liquidation. So basically, these are the characteristics of a declining company. So at the late stage of the company, we would have notable concerns in valuation. For discounted cash flow techniques, these are the concerns. Number one, earnings may be less than the cost of capital. Remember that whatever projects the company enters into, it should create excess value. But in the case of a declining company, maybe value is being destroyed rather than being created. We would expect earnings to be less than the cost of capital, so the inflow is less than the outflow to the investors. Then we have increasing cost of capital brought by distress. So for those declining companies who are already entering into bankruptcy or at the threat of being bankrupt, we would expect the cost of capital to go up, putting a constraint on the company's ability to make other projects whenever it's possible. Then finally, we would expect a negative growth, especially the one assumed in the terminal value calculation. The growth rate would be negative. Rather than looking forward to infinity at a constant growth rate, we would look at a declining rate, a negative growth rate. So these are the notable concerns in the valuation of a declining company using the discounted cash flow techniques. So what are we going to do when it comes to valuation of a declining company? Well, let us assume that there are no signs of distress yet. Meaning to say, the company is not yet forced into bankruptcy. There are no defaults being made yet, and there are no lenders bugging the company to give back their money. There are two possible scenarios. Number one, the decline is reversible. How are we going to arrive at the value of the company if the decline is still reversible? It is still possible to bring back the company to a growth phase. So what we can do here is to do the same thing as we did in mature companies when we value for control. What we can do here is to assume, number one, the status quo value, then multiply it by the probability that there will be no changes to be made. So that would be a percentage weight. And then also calculate the value assuming that the existing management will be replaced by some management that's better in turning around the business, bringing it back to the growth phase. So plus the value, assuming it is run by the best managers the best possible way, that's the optimal value, multiplied by the probability that the management will be changed. This is the same way of calculating the value for mature companies when we account for control in the previous video. So if there are no signs of distress yet and the decline can be reversed, what we can do is to assume two values. The existing conditions, the value under existing conditions, the status quo value, then the optimal value, the value under the assumption that it will be run in the best possible way, then multiply by the probabilities that each of the condition will happen. Now, what if there are no signs of distress yet, however, the decline is no longer reversible? Expected value of the company if decline is irreversible. So there's no danger of bankruptcy in the near term. However, there is no other way of bringing back the company to life. So say for example, maybe we are in the business of exclusively manufacturing typewriters and we do not see any possible event that we will be back to life. However, there are still a lot of typewriter sales. There's no rush for a bankruptcy. What we can do is, number one, we can calculate the value assuming the status quo. The status quo value with the existing decline. So we are going to do discounted cash flow valuation techniques. Take the present value, just assuming that there will be a constant decline of the company's operations. Then, we may also calculate the value of the company, assuming it will be liquidated in an orderly fashion. That is, the assets of the companies will be sold at an orderly fashion. So, if the company is already at a decline, maybe the assets of the company would be better off being used by some other business. Maybe we can sell the assets such as the property and machinery at a reasonable price. Again, it is important to take note that there is no distress yet. As a result, we can wait for the best buyer with the best price to make the purchase rather than being in a hurry in the event of bankruptcy. We still have time to look for the best buyer and to wait for the best price. What we're going to do is to compare these two values, the DCF value with existing decline versus the value of the company assuming it will be liquidated in an orderly fashion, and look for whichever is higher. That is how we are going to arrive at the expected value if the decline is no longer reversible. Again, so far in this discussion, we are assuming that there are no signs of distress yet. The threat of bankruptcy is still years away from today. Now, what if there are signs of distress? What if there are signs of distress? How are we going to proceed with the valuation? If there are signs of distress, we can do the following calculation. An expected value approach again. We can look for the going concern value, assuming that the business would still survive for an indefinite period of time. The going concern value, and multiply by the cumulative probability of no distress in the valuation period, meaning the forced liquidation will not happen, plus the value assuming that the assets will be sold in a very fast phase. We call this a distressed sales value. This is not an orderly selling of property and equipment. In a distressed sales value, the assets will be sold at a very cheap price in order to hasten the liquidation of the company, and multiply this by the cumulative probability of distress in the valuation period. So again, if there are now signs of distress, it is now possible that the company is going to be bankrupt in the near term. The company has already maybe defaulted a principal or an interest payment. What we can do is to, number one, still assume that it will be a going concern, multiply by the probability of that to happen, which at this point is very low. Then add the distressed sales value, assuming that we will be in a hurry in selling all the assets. What amount are we going to receive? Multiplied by the probability of distress in the valuation period. This is how we arrive at the value of the company, assuming there are now signs of distress. What about the concerns in relative valuation? Now, more likely, a company in the decline stage will have zero or maybe negative earnings. The companies may be operating at a loss. So, are we going to scale using multiples that involve revenue? Are we going to scale the value to revenues? We have to be very careful in doing so. When you are going to use revenue multiples, just because the companies are not generating profits, this is not a wise thing to do, because these revenues will mean nothing unless it will translate to future profits. So the only time that we shall use revenue multiples is when we are convinced that in the future it will go back to profitability. Now, an important concern in relative valuation is what comparable firms are we going to use? Now, in answering this question, there are two possible things to do. Number one, we're going to look for distressed firms, maybe in the same industry. So if we are operating a grocery, we should look for a group of distressed groceries in the market and look for what their price is trading relative to a variable. If the industry sector has none, maybe we can expand our search to other industries in the market, but we should do this with caution because those firms are no longer similar to the ones that we are valuing. Another technique of using relative valuation is to use companies that are not in distress as comparables, then do the following. Again, use companies that are not in distress as comparables, then do the following. Do an expected value calculation. We are going to put the value based on forward multiples of the healthy firms as a substitute for the going concern value. Again, we are going to use the value that we calculated based on forward multiples for healthy firms, those that are not in distress. We have discussed how to use forward multiples in one of our previous videos. Make sure that you know how to use it. And then multiply this by the probability of no distress. Then add the distress sales value multiplied by the probability of distress. In other words, we are going to do the same thing as we did in discounted cash flow technique, with the exception that in assuming a going concern value, we use relative valuation rather than a discounted cash flow technique. So basically, this is how we do valuation across the company's life cycle from cradle to grave. So thank you. Thank you for watching. Comment for the future topics that you would like to request. Don't forget to hit the thumbs up button if you like this video and hit the subscribe and notification bell to be updated for future videos.